Welcome to our clients and friends of the firm around the country and around. I'm Dennis Stearns. Welcome to our latest live chat. We have a significant amount of information that came across our transom this week from various research sources. We're going to try to encapsulate a bit of it today with our special guests, the co-chief investment officers of Stearns Financial, Glenn Joyce and PJ Williams. And then there's additional data that'll be in your written poolside chats that you will get later today. So let's jump right into kind of what we're going to be doing on our agenda today. Two main things we're going to try to cover today. The first is around what the C19 middle game, end game may look like. And we have, again, a tremendous amount of data. We're going to try to encapsulate some of that and then have some of it sent out next week. And then the second piece is we get a lot of questions about the disconnect of the stock market and the economy. And we've written about this over the years quite extensively. And many of the top people we deal with at universities and economists and so forth have demonstrated that they're not as connected as you might think. But that is really important to zoom in on in this pandemic. And so we're going to talk a bit about that. So, Bill, let's go to the Barron's quote, please. So, Glenn, this quote from Barron's actually mirrors something that we talked about in our chats live and written last week. To talk about this with us.
Yes, I think it's important to think about kind of what drives the economy. And given where we are today, we know this slowdown has been government induced, right? And so I think when you think about kind of looking forward, we do believe it's going to be a transitory situation. We will get through this. But the big question is, how long is it going to take? And one of the key things to think about is kind of what drives the economy. And when we think about the economic driver or drivers, one of the main things is around the consumer. Consumer spending typically represents about 2/3 of economic growth, so that's very important. And I think if we want to go to the next slide, we can kind of look at a chart here. It'll kind of help explain that story. So this chart is showing kind of industry or sector impact here in terms of not only the sectors that have felt the most pain or industries that have felt the most pain, but also kind of looking at the spending levels or earnings levels in those associated industries. And so if you look at what's kind of been hit the hardest, it's what you would probably expect, those socially dependent sectors. Think of service, think of retail, restaurants, travel. Those are the ones that have kind of felt the pain given they are so much dependent on social interaction. But as you also notice at the bottom scale, you can see in terms of their industry earnings, you can see they're not as high. They're more on the left side of the scale, much lower in terms of that earnings piece. Whereas some of the more bigger discretionary drivers are on the right side. If you look at whether it's education, healthcare, finance, information technology, those are areas where we're hoping to kind of carry the way here, at least until we can get through this. So obviously the federal government is trying to provide a stimulus. And also we just want to see if we can get through this and provide that bridge and rely on folks to continue to spend, especially those that are able to continue working. So I think this chart is a little bit of good news, and we'll hang on to that for now as we go on through the presentation.
Yes, and we heard when we published this a week ago in our written chat, we heard from a lot of people that this chart is sort of common sense in a certain area, but it really brought home the fact that the big major drivers of the economy are largely intact and largely not as affected by furloughs and layoffs and other things. And in the age of e-commerce and Grubhub and other ways for consumers to spend, you're right. This is a very interesting silver lining and one that we're going to watch and track in the coming months as the economy reopens. All right, let's go on to the next slide. So, PJ, this is one we have also shared in the past as far as the different um, letters that have been used: V shape, U shape, L shape, W shape. There's even now a square root shape concept. And so, just talk us through some of the latest research and what we're looking at with these different recovery patterns.
Yeah, so what we're looking at here on the slide is, as Dennis mentioned, three different possible recovery shapes for the overall economy. We're looking at where we are today. We just, in the last week or two, where the first quarter GDP was reported to have declined at an annualized rate of 4.8%, and that was for the whole economy. The second quarter, the forecasts that we are seeing are for an unprecedented contraction of over 30% during the second quarter. On the back end of that, and we'll talk more about what needs to happen for the back end, the second half of the year, to experience the recovery many are forecasting. Many are forecasting very strong recoveries in the second half of the year, which is how you get to these numbers of, in the V-shaped example here, an annualized decline of 1.2% for the entire U.S. economy for all of 2020, and the L-shaped of negative 5% GDP contraction in 2020. To kind of put this into perspective as to what we saw during the depths of the financial crisis, the fourth quarter of 2008, we experienced a contraction in the U.S. economy of just over 8%. So again, the first quarter was not as bad as Q4 2008, but we do anticipate that the second quarter will be unprecedented in its contraction. As Glenn mentioned on the previous slide, this has mostly been government-induced for the good of the overall country in terms of trying to deal with this healthcare crisis and help us move past it as quickly as possible. Now, when you're looking at these different shapes of recovery, this is looking at the overall economy. We know that there's different business lines, different sectors of the economy that are experiencing different paths to where they are today and where we expect them to go forward. And so with that, when you're looking at a V-shaped recovery, we think that there are industries that will experience that. There's many technology companies that honestly, are positive for the year on the stock market. They're seeing their sales grow. You look at something like we're on Zoom right now, you look at Netflix, you look at Amazon, strong performances for a variety of reasons, but it makes sense with the healthcare crisis we're going through. And then you get down to the more localized small businesses. I think you could see V-shaped recovery in something like maybe salons. We've all been at home now for 6 weeks, and maybe you don't want your spouse or the person you're living with or your family member to be cutting your hair. And so when the different states allow for the opening up of the economy, I think the salons will get hit pretty hard. I think counseling services will get hit pretty hard and experience a recovery from this, as this crisis has taken a toll on many different parts of the country in different ways. I think it's also important to know that the different paths of recovery are very dependent on the regulations that are implemented at the state and local levels. We've heard earlier this week that LA County in California expects to extend the stay-at-home order for 3 months. We've also heard that California state university programs do not anticipate having students on campus in the fall. Well, that's going to dictate the recovery for the businesses localized to that area. Just 2 more notes on the U-shaped and L-shaped recoveries. U-shaped recoveries, that's going to be more your restaurants, maybe your healthcare systems, where as you slowly open back up the economy, people are able to go to the restaurants, sit down. We're still not there yet, and that's why we think that this is going to be a whack-a-mole situation where pockets of the economy may open up and then they may be shut down if we get a second wave or we get new coronavirus cases flaring up in different areas. The L-shaped recovery, energy, travel, leisure, cruise ships especially, the future for those industries is very much unknown right now until we get past the healthcare part of this crisis. And so, Bill, if you can go to the next slide.
Well, yeah, and before we go to that next slide, I just wanted to make the point that on the L-shaped recovery in restaurants, there's some famous restaurants in New York City who have basically said, we're not sure we can reopen as long as we have to have physical distancing in place. And then there's a really famous one that recently said, we're providing barbecue to children and disadvantaged families all across the city. And frankly, we don't want to reopen. We want to continue to be able to do that. And so there's just a lot of really interesting nuance, even within categories of restaurants and other areas. Yeah, so Bill, let's go to that next slide.
So on this slide, what we're looking at is similar to the previous slide, the different scenarios. Here we're looking at the V-shaped and the U-shaped, but we're looking at duration. And again, that's a key here for thinking about the markets, which Glenn mentioned earlier, and we'll talk about a little bit later, is how forward-looking are the markets in terms of the stock markets, in terms of how long this is going to go on for. And so you can see here, relative to what we experienced with the global financial crisis and the Great Depression, you know, because of what the catalyst was for this crisis, being the healthcare situation with the COVID-19, along with the shutting down of parts of the economy by the government, the forecast right now, based on what we know today, is that the duration of this crisis will be shorter than what we experienced with the global financial crisis. Again, and we'll talk about in the next slide, a lot of this is still dictated on where we go with and what happens with the overall healthcare situation we're dealing with. A shape we haven't talked about on this slide or the previous one is W, and that's really what we're watching for in terms of that second wave. You know, if I think the U.S. and many parts of the country are doing the best they can to prepare for a second wave, and that the healthcare systems would be able to absorb it in a more efficient and better fashion than they did during March and April. But that is what is going to be, at the end of the day, what dictates the ultimate shape of our recovery.
Okay, good. And good to mention also that PJ's wife is on the front lines of the healthcare industry, and again, thanking her for the risks she takes every single day. All right, Bill, let's go to the next slide.
And so we showed this slide before, and again, we're looking at kind of a 3x3 layer puzzle here of uncertainty, and each one affects the other one in a different way. And so we just talked about on the previous page, you know, for us at Stearns right now, we really are looking for the path of the disease. You know, where do we end up with potential treatment options? Where do we end up with potential vaccine, contact tracing, whatever it may be? You know, there's been some positives with Gilead's remdesivir trials, but there's a long way to go before those are cleared for use across the country. You're seeing that there's a number of different biotech companies and major drug makers around the world working on a vaccine. It's very difficult to make a vaccine, and there's no guarantee we will ever have one, but there is progress being made. Sanofi in France is definitely making some progress. And you look at what we are doing as citizens of this country and local governments in terms of wearing masks in public, staying home still if you don't need to, trying to mitigate the chances of that second wave hitting really hard. And so that's really what we're watching for, is where things go on the healthcare side. Now, what that affects is, you know, if we are past the peak and we are able to manage the new cases because of how we set up, you know, we've got more ventilators coming, we've got, you know, more PPE coming, all this stuff is setting us up to hopefully be better prepared if there's a second wave. And so if we can absorb that second wave relatively well compared to how it went the last 2 months, then the U.S. economy hopefully can experience that, in Stearns' opinion, that U-shaped recovery, which is our expectation for the overall economy, where it's a slow, gradual recovery from here, where you experience pop-ups of flare-ups of maybe needing to take a step back, but hopefully then 2 steps forward coming out the other side. Now with the stock market, what we've seen is the stock market, again, not the economy. You've seen the stock market fall very sharply during March, rally very strongly during April. There's lots of reasons for this, and we will talk about those towards the end of the presentation in terms of what's been driving, especially the rally that we've experienced in the market as parts of the economy continue to remain closed, and you're experiencing these, I guess, economic data numbers, whether it be unemployment, retail sales, GDP growth, that are very unprecedented in many ways, going back, you know, really to the era just before World War II.
Okay, thanks. So Bill, next slide. So Glenn, this was the title of a recent New York Times article, "Repeat after me, the markets are not the economy." What should we take away from that?
Yeah, I think when you think about the markets and the economy, there is a disconnect. I think a lot of times you associate if one's doing well, the other is going to do well, and concertedly, I guess, at the same time. and in concert. So this talks about just the composition of companies and how they've evolved over time and how they are distinguished from your smaller businesses, which are really the heartbeat of America. But just talking about the access to capital and how they can respond much more, and they have access to the public markets and just much more insulated and able to adapt probably a little more quickly. And I think this always brings back just some quotes that we've used. You've probably heard us in the past talk about, Benjamin Graham, the father of value investing, and Warren Buffett, his protege. And one of Ben Graham's, or at least the quote that's been attributed to Ben Graham, I think in his security analysis book, was talking about these drivers of the market. And in the short run, the market is more of a voting machine, but over the longer haul, it's more of a weighing machine. And what that means is the voting machine means that the market is much more susceptible to swings in investor sentiment or psychology. And we all know we fall into those emotional traps at times. The weighing machine is where we get more to the long-term drivers of the market, which are more fundamentals, particularly around corporate earnings. And so we do have more confidence as we look further out to say, we feel like the market's going to do and probably go pretty much in concert with the economy over longer periods, as long as economic growth is going well and companies are able to continue to adapt and be productive. The other quote I think that is very appropriate during this time is from Warren Buffett, the protege. And it talks about how people are always saying, or at least a lot of folks will say, well, let's just wait till things settle down with the economy and I'll get back in. Let me get out now and wait till I get the all clear signal from the economy. Well, the problem with that is this quote is, if you wait for the robins, spring has already sprung. So it just we really had that happen this particular quarter where we've seen that strong V-shaped recovery. We hadn't gotten back up quite 60% of what we lost. But, it's definitely been a strong pop back up. And I think it just kind of shows you there's much more than just fundamentals. There's much more in terms of sentiment. And the market is forward looking. And while we're sitting here trying to analyze what does this mean, the market a lot of times is already kind of baking that into the cake and has already started moving forward based on how the market sees things developing over the longer haul. So why don't we go to the next slide, Bill?
Yeah, to a certain extent, we've kind of seen both of those things happen. So, what you're seeing is, even though we think the economy may be U-shaped with those moles popping up on the back end, and as PJ said, if they're big moles, if they're buffalo-sized moles, and we have new waves that are coming of the virus, that's going to have one impact short term on the stock market in terms of psychology. And then if they're small moles, maybe it's just regular U, and so the economy can have a U, but the stock market can have a V, and different segments of the stock market can have an L. So again, I think that's the really important takeaway here, and part of what we're actually doing in a lot of our strategizing for the future. So yeah, Glenn, talk about this next slide.
Thanks, Dennis. Yeah, this next slide looks at the Bloomberg Financial Conditions Index. And what this is, this tries to gauge, how are financial markets, credit markets responding? Are they operating efficiently, or is there stress in the markets? This slide is inverted, which means it's working from the top would be the negative kind of bad environment, like a -10, -14 being really bad in terms of stress. Things are very tight from a credit perspective. People are kind of afraid to lend money. There's just a lot of uncertainty. And you can see here, this compares the 2020 COVID crisis with the great financial crisis of 2008, 2009. And you can see there's some similarities, but note how we really have bounced back rather quickly with the COVID crisis. And I think a couple of things to think about. One is this is a little bit different. Once again, the 2008, 2009 crisis, which much more about the financial system, kind of uncertainty around the banking system, and things were just kind of broken. And that created a lot of fear and anxiety and some permanent damage. It took quite a while to kind of work through. This, once again, is more government induced and gets back to, can we have that bridge, that lifeline over the next months, quarters, to kind of get people back to work? And that's the big question is, we're trying to figure out, like PJ mentioned, like Dennis mentioned, what does the recovery look like? Is it U-shaped? Is it square root shaped, with some sectors or industries bouncing back quicker than others? But we do think it's going to take some time. And I think right now, back to the prior slide, just briefly, we say where we are, but just in terms of the markets have responded, right? Like we talked about. And the question now is that we're really trying to assess is, have they kind of grown a little bit too optimistic with this V-shaped recovery, given that we may have some time to work through the economy recovery? So I think that's kind of where we are. Why don't we go to the next slide, and we'll talk about, just wrap this portion up. So this is an interesting quote here. Once again, we're trying to talk about the connection between the market and the economy. And it's interesting how just the composition of the S&P 500 and some of the key companies has changed over time. Productivity, technology, there's been a lot of things that have really kind of changed how the workforce looks and just how companies are able to operate. And this quote just really shows, this particular comment shows how, in terms of the most highly valued companies, it's changed over time, and the amount of the workforce tied to each one's changed. So, this is a very dynamic environment we've been in. Things are changing rapidly. And I think, that's the thing is we'll talk about more and more, it gets back to being able to be trainable and being able to, know that there's a lot of uncertainty ahead in terms of jobs. And I think we feel like we're getting through it, but it's still a little bit ways to go.
Yeah, and that sort of brings up an interesting point. A few years back, we did a Future of Jobs as Stearns Financial Trends newsletter, and talked about the massive changes in jobs over the next 5 to 10 years. And everything we're looking at now and research we're getting virtually every day says this trend is accelerating. And so if you're on the cutting edge of your particular profession, good for you. If you're not, this may be a time to try to up that game. So let's go to the next slide. So this really gets to the heart of what Glenn was talking about, that longer term weighing machine. And it's what everybody forgets. Everybody's got such a short-term myopic view of what's going on. This is actually the fundamental, that when you don't have the emotions flowing in the stock market, is really what it's all about. So PJ, walk us through this.
Yeah, so what this quote here from River Park research is saying is that as disruptive as this virus has been in the markets, the intrinsic value of many businesses has not materially changed. For a company like Alphabet, who's the parent company of Google, this year's cash flow represents around 5% of the next 10 years projected cash flow, and thus is really insignificant in the calculation of intrinsic value. And this is something that, this is not just related to Google. You look across the spectrum of really many of the technology companies, whether that be a Microsoft, whether that be something like a Netflix or an Amazon. What's going on right now is not materially changing where they're at today, but also where they're going. They have not been impacted the same way that an energy company has, with the lack of demand from energy collapsing across the world, from the lack of travel, the lack of production, economic activity, with energy prices collapsing. Same thing with retail. You're seeing in consumer discretionary, things that people don't really need right now. You're seeing collapses there, and that is materially altering the intrinsic value maybe of those companies, at least until we experience a recovery or have a better idea and pathway to the recovery. But for an Alphabet, for Microsoft, for Amazon, things are going okay for them. And we'll talk about Microsoft here on the next slide. So again, Microsoft has continued to string together impressive quarters with growth in their revenue, operating margin, which is very important in a time like this. One of the areas that really is carrying Microsoft, and a company like Amazon is also benefiting from it, and Google, is their Azure platform. So Azure for Microsoft is their cloud platform. So think of, you may also be familiar with Amazon Web Services, AWS, Google's cloud. These, the more businesses work from home, the more stuff is going to end up being stored in these clouds so that they're secure and can be accessed. And many large companies, such as Netflix, run their entire network operation on one of these three providers. And so with what's going on and what we're seeing in terms of how businesses are changing with the remote working environment, and or the increased demand for certain businesses, Netflix being one, as well as Amazon, you're seeing that what they've created and what they're dealing with COVID is actually a boost to not only revenue, but also their customer base and other areas of their financial well-being. Another area, obviously, is that these companies look strong right now. And so if they do want to borrow, and some of them have, they're able to borrow at incredibly low interest rates. And with a strong balance sheet that's already in place, with strong customer growth and strong revenues, they're setting themselves up for a great performance from a financial standpoint over the next five years. But when we translate that to the markets, that may be a little different story in terms of where is their potential growth from here. Many of these names have not experienced what you've seen in the energy space, the financial space, and other parts of the economy, industrials, that have been hit really hard. Many of these names are up on the year. You look at something like a Netflix or an Amazon, up double digits on the year. So, when you look at their valuations and their forward-looking prospects, great companies with solid balance sheets. But in terms of the upside from here, it may not be as much as you see with the energy space, but there's a lot more, I'd say, short-term, near-term risk in some of those more beaten down areas that you need to consider when you're deciding, how do you want to maybe invest your portfolio for the near term and the long term, what type of risk you're willing to take.
Yeah, I think that's a great point, BJ. And it's not just in the technology space. I mean, we're reviewing on average probably 5 to 10 of these Morningstar and other research things on individual companies every single day. And the recurring drumbeat is on a longer term view. Again, going back to that 10-year intrinsic value, the cash flow near term is a fraction. It is not 1/10. It is less than 1/10 for almost every single company, whether you're talking about DuPont, Dow Chemical, Honeywell. I mean, the list goes on and on and on and on. And so when you think about that, and there's an impact to something over the short term, 12 months, I mean, right now it's feeling like an eternity for those of you who are sheltering at home in place. But when you think about it for that short run, it's actually not creating a 30% decline in intrinsic value of that company. And yet many of the companies we're looking at have a 30% decline in their valuation. So great point that some of the companies, I mean, full disclosure, Microsoft has traditionally been one of our top holdings in our firm. So it's not that we don't like it, we like it a lot. It's just that from a valuation and a forward-looking return viewpoint, there's some other things that are probably going to have a little bit better returns over inflation. Okay, so let's go to the next one. Yeah, so PJ, walk us through this. I think this is a particularly interesting strategic overview.
And I think this is a great slide, and we'll look at the next slide as well. We'll show this. When you're thinking about the economy versus the markets, you've seen the economy with the sharp decline in retail sales, the significant decline in employment and GDP. Okay, but the market's doing really well. Well, if you look at the overall market, you look at the breadth of the performance, meaning how many companies are going up and down in a given day. The breadth has been relatively weak when we've been going up, but it's been dominated by the tech companies, which are also the largest companies. So when you're looking at this pie chart here, what we see is that dark blue slice of 40%. 40% of the S&P by market cap is in tech, internet, retail, and media, all sectors that have held up relatively well or benefited from the COVID-19 crisis. You also look at the lighter blue on the right there, non-cyclicals. Think healthcare, think consumer staples, think a company like General Mills. Again, also areas that have held up relatively well. What you have in the bottom left-hand part of the pie, the financials and cyclicals, think energy, think industrials, those areas have been hit really hard for various reasons as a result of the crisis. And so although they are, and the fact that they only represent a small part of the overall market cap of the S&P is one reason that you might see that supports why the market's not down more than it is right now. It's because it's being held up by that top left dark blue piece of the pie. And I want to compare this kind of to what you see if you look outside the US. And so if you're looking in the developed international world, so think Europe, think Japan, if you did the same pie chart, the largest pie slice would be financials at 14%, and technology would be sitting at just under 8%. And so that's another reason for right now in the short term why you're seeing a a gap in terms of performance from the U.S. and international is the composition of the overall markets. Over in Europe, especially dominated by financials and industrials, versus us in the U.S. right now being dominated by tech, which again, as Glenn mentioned, and we alluded to when we were looking at what did the market look like back in, I think, 1962 with AT&T and General Motors to today. We've seen this, and we showed a slide in our first quarter or our annual review and outlook of, you look at 10-year increments every decade for the last 5 or 6 decades, you see the changes every decade from who the leadership is, energy to financials to today. We're definitely sitting at technology. None of us know where we'll be in 10 years, but it's definitely an interesting trend that we'll be following to see, is tech able to maintain its hold as the largest part of the S&P and the U.S. market, or is there another industry group that takes over?
Yeah, and I think that it's kind of interesting, and we'll tackle this in some future chats around the U.S. versus international. Which one is the better return prospects going forward? I was on a national webcast for a major endowment this morning, and they had an economist on there, brilliant guy, who basically said, yeah, we think actually international has better return prospects over the next 3 to 5 years. And there were a variety of reasons for that. Again, we are seeing some others say, but there's also reasons to be more U.S. centric right now. So again, we're trying to stay balanced in some of this thought process until we get more data and get more actionable intelligence. All right, so let's go to the next slide. Yep, PJ, walk us through this one.
Yeah, so on this slide, we're looking at how our consensus forecast for the second quarter's earnings per share growth compared to, if we look a year ago, to the second quarter of 2019. And you can see that overall in that first column, it's anticipated or forecasted that earnings EPS growth will decline by over 40% from Q2 2019 for the overall S&P 500. But if you look at the dispersion to the right, the next 4 columns, there's a wide dispersion of where the declines are. You look out to the far right, cyclicals, mainly led by energy and consumer discretionary industrials, are expected to fall significantly into negative territory, which again, in the energy space, not surprising that we're anticipating losses during Q2 2020. You then move from right to left. Financials are expected to experience a significant decline. We have low interest rates, and we have potential increases in bad loans. Now, again, how much the Fed backstops that on the balance sheets of financials, the Fed has said that they are willing to step in certain situations. And so we'll have to see how it plays out to see where and if they do step in, if a large percentage of loans on banks' balance sheets do go bad, as we saw back during the financial crisis. But then you look at the next 2 columns. You look at non-cyclicals, and you look at tech, internet, retail, and media. Earnings are not expected to be that bad relative to what we're experiencing as an overall economy relative to 2019 second quarter. And also, it's no surprise, as a result, the stock performance of many of these companies has been relatively well and positive. You look at the best performing stocks in the S&P in 2020. We have Chewy, which, if you're not familiar with, is the kind of internet retail for pets. It's over a $16 billion market cap today. And so you compare that to Macy's, which is under $2 billion and struggling to survive and trying to raise billions of dollars of loans. It's interesting to see how things have changed. Other companies that are doing well this year, no surprise: Amazon, Netflix, Clorox, cleaning products, Activision Blizzard, that's a video gaming company with more people staying at home, and then eBay. So again, we see why we're not expecting larger decreases in those areas. But more importantly, it's also why you're seeing the strong rally in the stock market being pushed up and supported by these larger companies like a Microsoft, like a Google, and Amazon that are experiencing pretty decent performance during what we would say is a economic crisis.
Well, yeah, and that's where you get back to the my drawing's a little bit off here. 28% are those far right. It looks a little bit like my 7-year-old's drawing. Sorry, everyone. 28% on the far right, financials and cyclicals. So the area that is the greatest pain right now is 28% of the total, going back to the previous slide. And what's interesting, we had a few clients from a week ago in our written chat where JP Morgan and Morgan Stanley and Goldman Sachs had been predicting 50 to 60% rebounds in the earnings of these in 2021. And folks were like, well, how can that be? Well, they're called cyclicals for a reason. They are cyclical in their nature, and it just so happens we're living through perhaps one of the greatest magnifications for that particular sector of the downside and the upside, certainly in a generation. So let's go to the next one.
So the purpose of what we wanted to talk about on this slide really is looking at the blue line shows what actual earnings have been on a rolling 4 quarters basis going back a couple years, and then look at 2021 projections. Not surprising that as we've gone through the first quarter and here over halfway through the second quarter in 2020, that the 2021 estimated S&P 500 earnings has come down sharply, just given what's going on in the broader economy. But you can see that even with this sharp decline, the forecast as of now, which, if the U-shaped recovery occurs, we think that these forecasts may be a little rosy, but maybe in line. If many of the industries are able to come back up and we do not have a second wave, you're seeing 2021 earnings projections in line with where we ended 2019, which was a very strong year. So again, we will have to monitor how the healthcare crisis plays out, then how the overall economy does, and then we'll get down to, looking at the fundamentals of the individual companies. Do we get the snapback, as Dennis mentioned just now, in some of the cyclicals to support some of these earnings projections? Again, too early really to be thinking a lot about 2021. When you think about just this past quarter, 79 companies in the S&P 500 as a result of COVID-19 and the uncertainty going forward withdrew annual guidance of where they think their own company earnings are going. So, consensus estimates out that far, we think, are a little hazy at best, but it's something we'll be continuing to watch as we get more solid data from both the healthcare and the economy over really the next 1 to 2 quarters.
Yep. So thanks, and we're running a little low on time. So let's take one question that we have. It relates to this core and explore concept that we've been talking about in our written and live chats. And how would you both describe the approach right now for a more conservative growth and income investor versus maybe a growth investor with a longer time horizon, maybe a higher tolerance for risk?
I guess I'll start out. TJ can finish up, but this is Glenn. I think the way we would think about when we look at both those camps, the more conservative growth and income investor, and then the more growth or opportunistic investor, you have to look at their makeup, right, and kind of decide, what's their true objective. And we think about things like time horizon. We think of things about like need for cash or liquidity and how soon that may be. And we also just think about their individual profile, in which we have to talk to clients kind of one-on-one and find out more the psychological makeup, because that usually rules the day. If a client has the fundamental characteristics, take risk, but at the end of the day, if they just do not feel like they can do it, they can't eat well, sleep well, and they're just stressed out, they need to let that override that fundamental criteria. So when we're thinking about conservative folks, we're thinking about usually more capital preservation. And so the core and explore, we always want to have a good core diversified mix of underlying investments, that diversification asset allocation, kind of what you use as that foundational holding, the underpinnings. And then you can take rifle shots, in terms of areas, whether we think that some areas are beaten up maybe more than others and have a margin of safety built in. We're right now noodling over a lot of areas like financials, PJ mentioned, certain industrials, even maybe specific areas. But we probably do a little bit less of that in the growth and income, given that capital preservation focus. Whereas you flip over to the growth side of the equation, now you have much more an opportunistic mindset. Maybe you have a longer time horizon, just the ability and willingness to take on more risk. And you're looking for opportunities. You feel like you can make it up. If the market falls, you'll ride it out and you will just benefit by buying low. And so these folks, we're doing more of that. Like, for example, the energy trade, we have focused a little more on energy this quarter. And so I think we're always trying to just figure out, is there areas, and we're still evaluating, because the areas that have been hit the hardest we're like, okay, if we do go back down and we start retracing some of this recovery that we've had, do we feel like these areas will go down as much as they did the first time? And I think we would probably say no, but at the same time, we're trying to assess all that. And so really Core and Explore, and I'll let PJ pick up, is really just, making sure you get that foundational piece, and then trying to figure out there's certain areas where you can add value from a risk reward perspective and where we see opportunities.
No, Glenn, I think you did a good job explaining how we're really viewing this in terms of making sure the first and most important part of this is that what we're doing makes sense for the specific client we're doing it for. And so knowing that the client is in the right risk tolerance, and we know their situation for their financial plan, and then implementing it based on what we know about their willingness and ability to take risks. And so again, a lot of this will be client dependent. And again, that Core and Explore, really the explorers on the margins to enhance the overall return, acknowledging that it's in areas that have been beaten down more and areas that have more uncertainty. If they didn't have the uncertainty, they wouldn't be trading where they are today.
Yeah, very good. And so our final question, Glenn, we have an attendee who wants to know, what is that behind you? Because they want to jump in the car and travel there immediately. It's so calm.
Yeah, so it's interesting. This is a second time I participate, and a few weeks ago when I participated, I tend to pick backgrounds that are based on my family history and just fond memories that I've had growing up. And last time I did the Texas Hill Country, and this time I've got picked Lake Michigan. And so this is just north of Holland, Michigan, for anybody that knows where Holland, Michigan is. And this is a view from the back of the cottage that we rent every July and rent for a week. And so my family, the Ransford side of the family is generous enough to take care of that. And we drive up every year and enjoy looking at that. And I just trying to think kind of calm and tranquil thoughts right now about a lot of things.
Yeah, very good. And so I guess just in the interest of risk mitigation, we probably ought to mention that Michigan still has a rising infection rate. So maybe you don't want to jump in the car right away to head to that locale. Okay, thank you, Glenn. Thank you, PJ. Appreciate all that comment. Some very, very important points today that help sort out kind of some of the things that we're seeing. We also, this session, as usual, is being recorded, will be available on our SFG YouTube channel for those of you who have subscribed, and then we will also be sending out the link on Monday. And we invite all of you to also attend our 4 p.m. live chat session this afternoon. We have a very interesting one, the origins of wine, literally the birthplace of wine in California, a phenomenal story, lots of history, and we understand that we're going to be getting a special offer too for our clients and friends if you want that gift of wine during the pandemic. So again, on behalf of Glenn and PJ and everyone at SFG, we hope that you all have a wonderful weekend.